Under Ind AS, what are the components of your financial statements? So what does it mean? We'll discuss each and every component one by one. What has to be disclosed in each and every component and how to understand it with practical examples. So first component is, as I discussed, the balance sheet. So the balance sheet is nothing but under IFRS, this is called as Statement of Financial Position (SOFP). Then you have a statement of profit and loss and other comprehensive income. So balance sheet is nothing, it is similar. Statement of P&L is also similar. What is new is this other comprehensive income. So let's understand this in detail. Friends, I've seen so many people who till now, even after application of this Ind AS in a detailed manner, till now they cannot understand what exactly the OCI is. Or many people who have applied Ind AS or to whom it is applicable still they do not understand this concept of OCI. So let's discuss this also in the detailed manner. Now, OCI is nothing but an additional statement to the statement of profit and loss. Under Ind AS, they have defined certain particular transactions which are rent expenditure account, or you have repairs and maintenance account. How all these expenditures are transferred to statement of profit and loss at the time of financial reporting. In similar manner, they have disclosed certain transactions which are to be routed through other comprehensive income. So these are obviously certain gain or loss positions. So these are profit items or gain loss items itself. But these items are not to be transferred to P&L, but these items are to be transferred a additional statement, which is like a profit and loss itself, which is in addition to the P&L, which is called as statement of other comprehensive income, also called as OCI. Okay, so for example, I'll just give an example. And what is the purpose of this classification? So the main purpose of this classification is, many times the readers of the financial statements should understand what is the profit out of the normal activities or normal transactions of the company, and certain transactions which are not peculiar in nature or which are not out of normal routine activities of the company are been addressed by the standard, are been mentioned in the standard, and only these particular standards, because they should not hamper the profitability of the company on a day-to-day basis, they have to be disclosed in the other comprehensive income. Okay, so what are these items? And please understand, friends, you cannot apply a normal logic that this item is not in a routine nature of the company, and that is why I'll classify to OCI. You don't have a discretion, friends. Only the items mentioned in the standard are to be disclosed as to be routed through OCI, and it is mandatory. Again, you don't have an option. You cannot say that instead of OCI, I will show it in P&L. It is not allowed. This is a purely rule-based part of the standard. So as it is, you have to apply the concept, and as it is, you have to show in the other comprehensive income. So, for example, investment in certain equity instruments which are not held for trading. So company is not holding it for trading, and company is not earning day-to-day profits out of it. So the gain or loss arising out of such instruments or such equity instruments, the entity has an option to disclose or to route these gains and losses through the other comprehensive income. And if this option is exercised, any kind of gain or loss from my investment has to be disclosed in the other comprehensive income. To explain it in further detail, for example, if I am a company, I am investing in my lot of group companies. So these investment in my group companies are to be fair valued at each reporting date. Now tell me, is the investment held for the purpose of trading? Am I gonna earn day-to-day profit out of my investment in the group companies? Obviously no. So at the option of the entity, they have given that you can route this gain or loss through the other comprehensive income. So what does it mean is, if my investment is of 100 and at a reporting date I fair valued at to 150, this 50 will not be shown as gain in my P&L, but will be shown as gain in my other comprehensive income. Second example, actual gains and losses, which is the most peculiar thing in any kind of company, as I've discussed before. Actual gains or losses are to be routed through other comprehensive income and are not to be transferred to the statement of profit and loss. So I'll show you one illustrative OCA. So this is the extract of a financial statements of a listed company. So up to here there was tax expenses, above there was revenue, expenditure, PBT, everything is same. You arrive at profit for the year. Now, after arriving at profit for the year, you have a second part of the statement called as other comprehensive income. They have listed certain items. Only against these items, if you have any gain or loss, you have to disclose it over here. So, for example, gain or loss on remeasurement of defined benefit plan. This is nothing but your actual gains or losses. So the company had gain over it and they have disclosed it over here. And this item was not debited or credited to the employee benefit expenditure. It should appear only once. It is not a case that you will show it in P&L also and you will just for the purpose of disclosure you will show it in OCI. This is not a disclosure statement only. You cannot show this item in your P&L and accordingly your profit for the year does not include this gain of 32 lakhs. Then gain or loss on fair valuation of quoted investments in equity shares. So this company had a heavy loss of 49,000 because of fair valuation of equity shares. So this company had a heavy loss of 49,000 because of fair valuation of equity shares. And again, your deferred tax standard also says that any kind of deferred tax on this OCI item has to be also shown it in the OCI itself. So if you have deferred tax on this item, they also have to be disclosed in the other comprehensive income itself. So if you will see, this is the profit for the year. This is the total other comprehensive income of 49,000, negative 49,000, and accordingly, your total comprehensive income is nothing but a loss of 36,000. So one more important thing, friends, even your EPS is computed only on the profit for the year. These are the items which should not impact your day-to-day profitability, and that is why even your basic and diluted EPS is also computed on the profit for the year component only. Okay, so this is the case in case of the other comprehensive income. And this is the most important concept to be understood. I have tried to simplify it as much as possible. Now, the third statement, which is called as statement of changes in equity. This is also a new statement under the Ind AS regime. Statement of changes in equity is nothing but a statement which shows the entire movement of equity from opening to closing. So, as on 31st March 2019, I will show the movement of equity of the current year. So, what was the opening equity as on 1st April 2018? What are the changes in the equity during the year? And what is the closing equity as on 31st March 2019? I will also show this movement in the previous year, which is my comparative year. So I'll show 1st April 17, movement for the period and 31st March 2000. So you have to disclose what was your previous equity under your previous gap, what is your profit under the previous gap, and what is the profit under the current gap. So friends, to give you more details over it, for example, if you are a phase one company, in such cases, your first financial year or your first financial year reporting is 2016-17. For 2016-17, you only have your Ind AS financial statements. But for a comparative year, which is 2015-16, you had financial statements under Indian GAAP also, and you have converged to Ind AS, and you have comparative financial statements for the year 15-16 also. So for one particular year, you have two profit and loss. Then your balance sheet is on 1st April 15 and your balance sheet is on 31st March 2016. You have two balance sheets, which is under Indian GAAP also and which is under Ind AS also. So only for these two balance sheets and only for one profit and loss, you have to disclose a reconciliation. So you don't have to disclose a reconciliation for your current financial year, but only for the financial year for which you had the two statements, that was which you had published under Indian GAAP also and which you had to publish under the Ind AS also. For these two items, equity and profit reconciliation is required. Now, moving ahead to the next part, which is the format in which you will disclose the financial statements. Now, friends, under the Ind AS regime, you have a Schedule 3. You had it for your Indian gap also, but for the Ind AS companies, you have Division 2 to the Schedule 3. So, if you are following Ind AS, then for the purpose of format of balance sheet and format of P&L, you have to go to the Division 2 of the Schedule 3 to the Companies Act. And for NBFC companies, you will have to go to the Division 3 to the Schedule 3 to the Companies Act. This Division 2 and Division 3 discloses what is the format in which the balance sheet and P&L has to be disclosed. Now, OCI I have discussed in detail format. I'll also show an illustration of a listed company for the statement of changes in equity. So you have the opening, you have equity share capital and you have other equity. You have as on the opening date, comparative year end and the current year end. You have to show all the movements in this equity share capital. Then you have other equity. You have all the components. You have securities premium, general reserve, capital reserve, share options outstanding reserve, nothing but the ESOP reserve, equity instruments through OCI as I've discussed, and the surplus in the statement of profit and loss. And you have one more component which is called as the non-controlling interest component. So this is the illustrative statement of changes in equity, which is a format